My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey folks, welcome back. Chances are, if you've been tuning in for a while, you've heard about all sorts of different asset classes. Definitely heard about multifamily. You've heard about investing in self-storage and mobile home parks and single-family homes and flips, et cetera, et cetera. Today, we're going to talk about a very different class. This is in the commercial side of things. It's in that beautiful sweet spot of triple net leases. But today, we're talking with an expert, AJ Peak, who focuses on medical practices and medical buildings as their primary asset class. And AJ has a very unique way about going about this, and I look forward to unwrapping this today. So zooming in from Colorado Springs, AJ Peak. Welcome to the show, AJ.
Thank you, Dave. Glad to have you here.
Yeah, I'm glad to have you. So I went through a little bit of an intro there, but if we could zoom out, give us a 30,000 foot perspective. What do you guys do at Health Wealth Capital?
We are searching for strong healthcare tenants, so from dental tenants, dermatology, urgent care, behavioral health, that are in good markets and strong. They're in, a great sector of the economy, healthcare, low bankruptcy rate. They're in a good market, growing sort of 50,000 population or more. And that's sort of the buy box of which we will buy the building and typically have a 10 or 15 year triple net lease in place.
Okay. So I was taking a look at your website, and to me, it seems like a really smart way that you go about this. So you're looking for doctors, dentists, et cetera, who own their own practice in their own buildings primarily, correct?
Correct. That's correct.
And then you're looking to purchase those buildings, keep those guys and gals in there as your tenant on triple net, so they're covering all of the taxes and the insurance and upkeep and all that kind of good stuff while they still own the business. And then with some of the money that you have paid them for buying their building, you're also getting them to invest in other deals that you've got going. Is that correct? Am I kind of connecting the dots there?
Absolutely. So they have the option to sell 100% or sell a percentage and roll into our deal and own a percent of many healthcare buildings. So diversification and, no longer active, but more of a passive investment. So they can do either option. So we can compete either way.
Okay, very good. So what is the situation where you find that most of these people are wanting to sell the property but keep their practice going?
Yeah, there's really three reasons. So as someone's thinking about the transitioning their practice, it might be a dental practice that, they think they're ready to sell it here in the next 5 or 10 years. If they also own the building, a lot of buyers, whether it be a private equity backed group or an individual buyer, they actually don't want to own the real estate. And so it can actually be a barrier to get maximum value for the practice. That's number one. And so getting that out of the equation can actually free up their ability to sell the practice. The second reason why people can do this is we'll pay as a multiple of EBITDA. Now, people in real estate think about cap rates, but if you own a healthcare business, you sell it on a multiple of EBITDA. And typically,
remind people that aren't familiar with that, what does EBITDA stand for?
It's profitability. So it's earnings before interest, taxes, depreciation, and amortization. It's basically the free cash flow of the business. So if you own a dermatology clinic or a veterinarian clinic or dental, it'll be somewhere between 4 and 6 times EBITDA is the way everybody sells their practices.
Okay.
Well, in real estate, you can mathematically convert a cap rate into a multiple of EBITDA. It's just algebra. Mm-hmm. And the cap rates at which we buy buildings, we're buying more at like a 12 times EBITDA, meaning the real estate is worth more to them. And if they can optimize for the right rent, meaning right now they're just paying themselves, but if they can sell the building and kind of optimize at kind of the top of the kind of market-based rent, they can engineer a valuation far more on the real estate. So if they sell the practice for a deflated rent, they're only going to get 6 times the EBITDA. If they sell the practice and rent is a little more robust, they're going to get 12 times that rental premium. And usually, if the audience is following me, it's almost 100 grand, sometimes a
Wow.
half a million, meaning the combined sell of the practice and the building can be 100 grand to 500,000 more if they do it the right way through a sales lease back with us in advance. So that's second reason. And the third reason, these medical providers, a lot of them want to keep growing. They want to
Hmm.
buy or build another practice. And the way they can finance it is they can do a triple net lease. That's basically a financial instrument, creates real value, pull that capital out, go buy or build practice number two or four or five. So it actually can be a source of capital for them to build their business and keep growing.
Okay. Yeah, that's making sense. So, from your perspective as an investor buying these buildings, forgive me if I misunderstood it, but by showing them this and getting them to do this, aren't you in a sense almost overpaying for these practice for these properties by doing it that way?
It's uh, most markets throughout the country rent if you go into a shopping mall or a professional building. The range of what the market is probably it ranges by $10. So it could be $20 a square foot to $30 a square foot. $18, $20. It's usually a pretty tight range. As
Hmm.
long as we're buying in that range and we have a strong tenant in triple net lease, this is it's valuable.
Yeah.
So, medical tenants already are in an industry sector with one of the lowest bankruptcy rates. I'm a former healthcare operator, having run healthcare businesses multi-site. So we do financial underwriting 3 years of the tenants to make sure not only we're a great sector, but they are high performing tenants. So if all of those check out, then actually we're paying, a good price for that property. And there's market precedence in terms of you can put those numbers together. It has incredible resale value.
Okay, very, very good. Especially if you're getting in some cases, getting a big chunk of the cash that you've paid them right back to you because they're
That's right.
investing in another
That's
project.
right.
That's kind of a perfect circle there. So I was watching one of your videos where you explained very, very well the benefits of this kind of investment versus apartment buildings, which is quite often what other people are kind of comparing it to. So, give us your take on why this makes so much more sense than investing in an apartment building.
So the all the value add, that's sort of the common term you hear in real estate. For us, is finding that right opportunity and right tenant. I actually know how to underwrite, meaning financially study a dental practice, and they're not all the same in terms of performance. So finding a high performing dental practice in a good market with a gold standard lease, all of that under the right financial terms is where our value add. Once we buy the building, I just want to collect rent. And so the big difference between what we do in multifamily, first would be the tenants. So obviously, this is a commercial tenant in healthcare, high margin business, necessity. If your teeth hurt, whether it's COVID or not, you're going to go see the dentist,
Right.
right? So it's sort of lots of recession resistant industry versus multifamily. You see a lot of recession influencers, whether it's a successful investment or not. The second is we're not buying a dark building or renovating an apartment unit and hoping we can rent it out for a certain lease rate. We know exactly what rent's going to be, and we have annual rent escalators negotiated in. The average weighted lease of our last series was 13 years. So leases between 10 and 15 years. 3 times our hold period is the length of these leases.
Hmm.
So in terms of security, in terms of distributions and revenues, we know what it is. It's a fixed number. On top of that, we have fixed rate debt tied with a fixed rate tenant. So I'm not doing renovation and hoping I can, refinance at a lower interest rates or worse, interest rates go up, sort of the fixed level of interest rates on that end. So for ours, the risk level, it's a lot more predictable. returns. And where we get upside returns is bigger is better. So I
Hmm.
built a big healthcare business, and when you're bigger, you have lots more profitability. You get a bigger multiple on that front. And in real estate, medical REITs are a great example. Institutional buyers, if you can bundle lots of these assets together that are well underwritten, there's market precedence for paying quite a premium for it. And so part of
Okay, that brings up
our
my next question. So, what is big picture? What is the exit strategy for you guys?
uh, somewhere between 10 million and 15 million of net operating income, which um, is over 100 to 150 of these buildings, dermatology, dental buildings, etc., all well underwritten. And there's several case studies right around 10 million to 15 million net operating income, well underwritten medical properties sold for a premium or are valued at a premium. So you can even look, even in all-time high interest rate environment, medical REITs implied cap rate is 4.88, which is just almost what treasuries are. It gives you an idea of how valuable this asset class is as you can pool more of these together.
Very cool. So, what does the portfolio look like right now, AJ? How many of these do you have on the go right now?
30 and about 50 million of assets under management. So we're about, a third of the way there.
Nice.
On the low end, we're going at a pace where we think, year end we'll have somewhere around 50 to 60 buildings and almost be halfway there.
Wow, that is rapid growth. That is fantastic. So there's finding the practices, finding the buildings. Well, I'm curious about that. What do you find works best to find these kind of deals? Do the dentists and the doctors and the owners of these buildings even know they want to be selling them yet, or is it just something you educate them about? Like, how do you find the properties?
All the above. It's really three sources. One, traditional broker networks.
Mm.
Occasionally, you got to sift through more of those deals to find the deals, but we will find good deals through brokers and some of those relationships. Through my network, building a large kind of healthcare group, have built a lot of relationships with um, key stakeholders, so CEOs of other big private equity backed groups, big medical brokers. So they're not selling real estate; they're buying and selling medical businesses.
Hmm.
Those tend to be inflection points for the real estate. And so through those intermediaries often get leads on that front. And then, through lots of different lists and associations, a lot of outbound outreach where you're educating them. They, hear about us, kind of go on a journey, learn more about it, and ultimately schedule time with us to see if it makes sense.
Okay, so that's one side of things, finding the deals. Finding the capital and the investors to fund these deals. What do you do in that respect besides, you know, getting some of the people that you buy from to invest with you? What else do
Yeah.
you guys do to find investors?
So on investors, we do 506c offerings and have partnered with some great, really supportive capital raisers. So I will leverage my network and usually source about half of the capital. And then I partnered with a team of capital raisers to sort of get the word out. Our last series we did in the last 6 months, 10 million, and the next one in the next 6 months would be 20 million. And have kind of have preferential, tranches for the capital raisers to make it, lucrative for them to bring this to their network and still give their investors kind of the same deal as if they invested with us directly.
Hmm. Yeah. Okay. Very, very cool. So exciting stuff on the horizon. Obviously, you're all in on this asset class. It can't always be all sunshine and flowers, AJ. So what are some of the not so great things about it?
I'd say it, it, the hardest part of what we do is getting the tenants to give us their financials. They think this is real estate, and why do I get to give up the financials?
Yeah.
And I'd say that ends up being quite an education. And there's a lot of deals that we don't do because we can't get the financials. Because
Hmm.
medical real estate, other competitors, other people will buy medical real estate all day long without financials, but our investment thesis is actually we're underwriting the strength of that tenant, so the financials. So I'd say that's one thing that's not so helpful. Um, it has not happened to us, but we are built to overcome it. We're buying provider-based businesses. So the real moneymaker is typically, one or two providers, a veterinarian,
You're talking about like the dentist, the
the
vet,
dentist,
whatever,
yeah.
right?
And I built a big dental group, and it was headquartered in Colorado, and dentists like to go skiing, and dentists sometimes break their hands or
Or their necks.
or their necks, and
Yeah.
people pass away. It's sad to say. Well, that's what generates money, right? And so you can do all the best underwriting, but if the provider dies or is disabled, that's a problem. And so we have certain things in place and buildings and things that we buy to overcome that. Most notably, we're sort of buying buildings in areas we feel are densely populated that we can get a short-term provider in place.
Mm,
If that business struggles to do that, we can. Like my team can do that to basically keep the business running, so we're still getting paid rent.
mm,
Um, that's happened to me building a healthcare business. It hasn't happened to me as a landlord, but I know one day it will.
mm.
And so we're built to kind of handle that, and we're buying assets to be able to protect against that downside risk. Big enough areas where we can source a per diem short-term veterinarian, dermatologist, dentist to keep the lights on while either that dentist heals or the heirs, God forbid they pass away, the heirs can
Yeah.
get the practice sold. Um,
Mm.
and so that's something you don't typically think about with other businesses, but with provider-based businesses, it can be um, a challenge on that front.
Is there any such thing as like key partner insurance for those kind of things? Is that even
So
a
we
thing?
have 12 months of rent protection,
Okay.
which is more than enough in this front. And typically, I built a large healthcare business. I never went more than 2 weeks dark without getting somebody in.
Mm.
So I've had businesses where people, terminally ill, other things happen and sort of have to move fast. Um, the other thing that we look for, the majority of our portfolio is private equity backed. So these are the large 100, 200, $500 million revenue businesses. They have a huge infrastructure to handle this when it happens.
Mm.
We have personal guarantees from the docs when we don't. It's probably those where we have this risk where we would lean in and get involved if we needed to. I hope it doesn't happen, but it's inevitable.
You
Of
got, yeah,
100
you got to be prepared for it.
locations,
Yeah.
something like that will
Statistically
happen.
speaking, something's going to happen to
Something
somebody
will
at
happen.
some point. Okay. As we're wrapping this up, AJ, this is fascinating stuff. I'm just kind of curious. Out of all the properties that you currently have under management in the portfolio, big broad strokes, what percentage are dental offices, dermatologists, veterinarians? Where does it kind of skew? I'm just curious.
Yeah, and I think it'll be this way all the way through exit. Um, 70, 80% it is and will continue to be dental.
Hmm.
I built a large $100 million dental business. I can underwrite that risk better than most.
Yeah.
Um, the rest is a predominantly veterinarian, dermatology, are the kind of bigger other domains. We have not yet likely spotted here urgent care and behavioral health. And they have some different healthcare exposure risks that we try to mitigate. But veterinarian and dermatology track very similar to dental in terms of how they operate and their financials, et cetera.
Yeah. Yeah. You've got a strong background in that. You can speak the lingo of those dentists all day long. That's for sure. Well, this has been fascinating, AJ. If people want to find out more and connect with you, where should they go?
They can reach out to me on the website at healthwealth.capital, and happy to connect with anybody has more questions.
Awesome. Well, keep up the good work. Congratulations on your success. And thanks for being part of the show.
Thank you, Dave.
All right, everybody, take care. We'll see you on the next one. Hey there. I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.